everyone, welcome back to Mitchell Markets. Today we're breaking down futures the right way because most people think MES and ES are the S&P 500 or they trade them without understanding what futures actually are. So let's clear this up right now. MES and ES are not the S&P 500 itself. They are cash settled futures contracts based on the S&P 500 index, giving you leverage exposure to price movement without owning a single share. You're not buying Apple, Microsoft, Nvidia. You're just trading a contract that tracks the index and is always cash settled. So let's break this down and get it precise so you have a more in-depth understanding of what MES and ES futures actually are while you're trading. So what is a futures contract? Futures are just standardized agreements to buy or sell the S&P at a set price in the future. No shares, no ownership, just pure exposure. If MES is trading at 7,000 and moves to 7,001, that's a 1 point move worth $5. Why? MES multiplier is $5 per point. The smallest move is a 0.25 tick worth $1.25, and 4 ticks equals 1 full point, being the $5. ES is the same thing scaled up. 1 point is $50, and a tick, which would be 0.25, a quarter of a point, would be $12.50. Same mechanics between the two, just bigger money. So as you can see on the chart, I have MES currently pulled up for December, and you can see the pointing system on the right of each chart. We have a 5-minute and a 1-hour chart pulled up, and you can see the pointing system on the side. 68.90, 68.80, and you may see a 68.71.59, but it still just works in the point system for buying and selling orders. So this 68.71.59 would be a 68.71.50 or 75, depending on the price fluctuation. Now we're going to go over notional value, your real exposure. This is what most beginners never understand. Notional equals the price multiplier. One MES is $35,000 exposure, and one ES is $350,000 exposure. So same product, just different size. And this is why futures can be so powerful. You can control a lot of exposure with far less capital. Now we'll go over margin. What you actually need to be able to hold a position. Margin is not the cost, it's just the performance bond to keep you into the trade. Typical margins for ES, depending on the brokerage you're using. This is a big thing. A lot of brokerages nowadays let you leverage to extreme levels. But if we're looking at a standardized quality brokerage, you're going to be looking at 20 to 50,000 margin availability for ES contracts. And for MES, you're going to need about 1,000 to 4,000 margin availability to trade those contracts. Now again, if you are on certain brokerages, like one I have experience with called Trade-Evate, these margin levels are far lower. You can trade multiple contracts with $500. You just might get blown completely out, as in go to zero extremely fast if you're trading multiple contracts. But typically a standardized brokerage that is a bit larger is going to require more of that high-end margin availability to be trading these contracts. This is why pros scale with MES. If you want about 20,000 with extra exposure without oversizing, you don't need an ES contract. You just add 3 to 4 MES contracts. MES is going to offer you a bit more precision and a bit more control from my personal experience. But if you are a large fund, you're almost exclusively going to be dealing with ES contracts. As retail investors, I think MES contracts can get you a bit more precise with your margin availability. Now, expiration and settlement. Equity index futures run on the quarterly cycle. March, June, September, December, and the third Friday. So for example, you can't see as the market is closed, but I currently have MES contracts open, and I have one more full week until the third Friday, of which these will be automatically closed, and I'm going to have to start buying into the following MES cycle. So for example, you buy MES at 7,000, it settles at 7,010, that's 10 points worth $50. You never receive stock, just a cash credit or debit. And if you want to stay in the market through that, you simply roll your position just by selling the expiring contract and buying the following month. And that's how traders can stay exposed indefinitely. And why do futures not always match the S&P spot price? Futures track the S&P almost tick to tick, but they may trade 1 or 2 points above or below the index. And that difference is called fair value, the cost of carry, interest rates, dividends, and so on and so forth. And by expiration, that small spread disappears. Futures and spots converge to the same price, no mystery, just math at the end of the day. So if this feels like a lot, relax. This is just a slow version. Once you understand multipliers, tick value, margin, then you're able to stop trading blindly and start trading intentionally. And this is the foundation that every trader needs to build on. And we're going to continue doing deep dives on MES and ES. But I notice I'm making some specialized trading videos on my MES positions that I take sometimes. And before I start getting more in depth in that, I wanted to make a video summarizing what exactly it is, because it can be complicated before you start doing it. And sometimes people who start doing it don't even understand what they're trading to begin with or how it works. So hopefully this helped, guys. Welcome to Mitchell Markets. If you have any questions or comments, please feel free to leave them below. Make sure to like and subscribe and continue learning about the markets.